Right now, as we're speaking, Tilray Brands Inc. is trading at approximately $1.28, which marks a notable intraday gain of around 3.2%, a move that stands out when you consider the volatility this stock has seen. The immediate expectation for a stock like Tilray, a name that's become a symbol of the broader cannabis sector's wild swings, is often tied directly to regulatory whispers or big headlines. But what's really happening today, beneath that surface-level price action, is far more subtle and points to a deeper strategic shift that most investors are missing. The story here isn't just about a one-day pop. It's about a long, slow grind away from the public eye that has the company positioning itself for a completely different future, one that may have less to do with the cannabis promises that originally captured investor imagination and more to do with consumer goods and global expansion. That's the tension at the heart of the Tilray story, the gap between the speculative hope of what cannabis legalization will one day bring and the gritty reality of building a diversified, sustainable business right now. The common belief about Tilray is that it's a high-risk, high-reward bet on the future of marijuana, and its stock price is a direct function of political developments in the United States and Europe. People see the ticker, TLRY, and their minds go straight to federal legalization, rescheduling, or major market reforms. This narrative is reinforced by the way the stock reacts to every piece of news, whether it's the Department of Justice walking back some rules or a new legislative proposal. However, this perspective, while not entirely wrong, is incomplete. It oversimplifies a complex company that has been actively and at times desperately trying to build a business that can survive without a magic federal legislative wand. While many retail investors managing their own holdings through platforms like Robinhood or Interactive Brokers might be waiting for that big federal news, Tilray's management has been working to build a more stable foundation. They've been a case study in diversification, almost to a fault, expanding into craft beer, spirits, and wellness products. The recent gains, like the one we're seeing today, are often not purely about a new cannabis law. They're driven by more practical, operational news, like the launch of a new seasonal beer lineup or expanding distribution for a spirits brand. Looking at the recent stock movement, the intraday price jump is accompanied by a significant trading volume spike. This isn't just a quiet day for the stock, there's real activity. The volume has jumped significantly from its recent average, a clear sign that both institutional and individual brokerage participants are taking notice. A week ago, the news of the Department of Justice canceling certain cannabis rules hit the sector hard, and Tilray stock felt the pressure. That particular piece of news was a direct hit to the U.S. federal legalization expectation, and the stock's reaction was exactly what you'd expect. But in the days since, the stock has quietly regained ground, driven by a series of company-specific announcements that have nothing to do with cannabis legalization in the United States. For example, the company recently announced new partnerships for its spirits business and new product lines for its international medical cannabis operations in Europe. These are the kinds of tangible operational wins that provide a more durable catalyst than political speculation. This is where the tension lies for an investor. Do you focus on the macro, unpredictable political drama, or the micro, steady, operational progress? The broader market context is also critical. While the general market, represented by indices, has been fluctuating due to macroeconomic pressures and shifting Federal Reserve policy, the cannabis sector has been particularly sensitive. Many of the companies in this space, Tilray included, are still in their growth phase, often operating at a loss. This makes them vulnerable to shifts in investor sentiment and changes in the cost of capital. When the market becomes risk-off, these stocks are often the first to suffer. Yet, Tilray has shown some surprising resilience on certain days, which points to a core group of investors who are looking past the industry-wide noise and focusing on the company's specific business segments. This is a very different investment thesis than simply betting on a legislative event. It requires a more nuanced understanding of the company's financials and its multiple business lines. For those who invest online, utilizing tools offered by firms like Schwab Intelligent Portfolios or Fidelity Investments, this multifaceted business model makes traditional valuation models difficult, forcing a reliance on qualitative analysis. So what exactly is Tilray Brands? At its core, it is a global cannabis company, but it's more accurately described as a consumer packaged goods company with a cannabis focus. Its operations are divided into four main segments:
cannabis, which includes medical and adult use products in markets around the world, beverages, which includes a portfolio of craft beers and spirits from acquisitions like Sweetwater Brewing, Breckenridge Distillery, and Montauk Brewing Company, wellness, which includes hemp and wellness products, and distribution, which handles the logistics for its own products and for other third-party medical cannabis companies. It has a massive global footprint, with operations in Canada, the United States, Europe, Australia, and Latin America. Its business model has been to grow through acquisition, attempting to build a diverse portfolio of brands to create stability while the cannabis market matures. The idea behind this strategy, which has been in place for years, is to reduce the company's dependence on the nascent and often frustratingly slow-moving cannabis market by building a base of consistent revenue from established non-cannabis brands. However, this strategy has not been without its challenges. The company has struggled with profitability, consistently reporting significant net losses. The expansion has come at a cost, and while the revenue figures have grown, the bottom line has often moved in the opposite direction. This is the reality that often clashes with the expectation of a high-flying growth stock. Analysts and investors alike have questioned the wisdom of these acquisitions and the debt taken on to complete them. The company's recent earnings reports have been a mixed bag, sometimes beating on revenue but often missing on earnings per share. This financial reality, coupled with the persistent issue of its low stock price and the risk of being delisted from the Nasdaq without a reverse stock split, creates a very real tension for anyone holding Tilray stock. The company recently regained compliance with Nasdaq's minimum bid price requirement, which was a huge relief and a non-cannabis-related positive catalyst that demonstrates the company's need to focus on fundamental operational matters. The fact that this was a major news item tells you a lot about the company's current reality. Looking ahead, the future outlook for Tilray is tied to two parallel stories. The first is the long-term potential of the global cannabis market. The expectation is that eventually major markets like the United States will open up, and Tilray, with its established infrastructure and global presence, will be a primary beneficiary. This is the pot of gold at the end of the rainbow narrative that has kept many investors holding on. A potential catalyst here would be the passage of federal legislation that allows for interstate commerce or broader financial services for cannabis companies. But this is a highly uncertain and politically charged prospect. A major risk is that this legislation never materializes or that it is so watered down that it doesn't provide the boost the market expects. Do you think the U.S. government will pass significant cannabis reform legislation in the next 3 years? Comment below with your thoughts. The second, and arguably more important story, is the company's ongoing success in its non-cannabis businesses. The reality is that Tilray's short to medium-term future depends on its ability to make its craft beer and spirits acquisitions profitable and to continue growing its international medical cannabis presence, which is less dependent on volatile legislative processes. Catalysts for future movement will likely come from both sides. On the cannabis front, any progress on rescheduling or federal reform will undoubtedly send the stock higher. On the consumer goods front, strong earnings reports from the beverage and wellness segments, successful new product launches, or a positive turn towards profitability would be major bullish signs. Conversely, risks include continued operating losses, further delays in legalization, and the potential for increased competition from other major players, not just in cannabis but also in the beverage space. The company's debt load and the potential for shareholder dilution remain overhangs on the stock. Ultimately, the Tilray story is a classic example of expectation versus reality. The expectation, for years, has been a singular, spectacular event, the U.S. legalizing cannabis that would send the stock soaring. The reality has been a messy, complicated process of building a business from the ground up, dealing with financial pressures, and navigating a patchwork of global regulations. The recent stock movement shows that while the speculative dream is still a part of the narrative, the market is beginning to pay closer attention to the operational reality. The company's future success will likely be a result of its ability to execute on its current strategy of diversification, rather than a single legislative event. It's a reminder that self-investing requires looking past the easy headlines and digging into the complex details of a company's business model.